When learning how to invest, it's important to learn from the best, but it also pays to learn from the worst. These top 8 most common mistakes have been compiled to help investors know what to watch out for. If any of these mistakes sound familiar, it is likely time to meet with a financial advisor. Welcome to our channel. Like, comment, and subscribe to support us. Let's jump right into our list. Number 1. Expecting too much or using someone else's expectations. Investing for the long term involves creating a well-diversified portfolio designed to provide you with an appropriate level of risk and return under a variety of market scenarios. But even after designing the right portfolio, no one can predict or control what returns the market will actually provide. It is important not to expect too much and to be careful when figuring out what to expect. Nobody can tell you what a reasonable rate of return is without having an understanding of you, your goals, and your current asset location. Number 2. Not having clear investment goals. The adage, "If you don't know where you are going, you will probably end up somewhere else," is as true of investing as anything else. Everything from the investment plan to the strategies used, the portfolio design, and even the individual securities can be configured with your life objectives in mind. Too many investors focus on the latest investment fad or on maximizing short-term investment return instead of designing an investment portfolio that has a high probability of achieving their long-term investment objectives. Number 3. Failing to diversify enough. The only way to create a portfolio that has the potential to provide appropriate levels of risk and return in various market scenarios is adequate diversification. Often, investors think they can maximize returns by taking a large investment exposure in one security or sector. But when the market moves against such a concentrated position, it can be disastrous. Too much diversification and too many exposures can also affect performance. The best course of action is to find the balance. Seek the advice of a professional advisor. Number 4. Focusing on the wrong kind of performance. There are 2 time frames that are important to keep in mind: the short term and everything else. If you are a long-term investor, speculating on performance in the short term can be a recipe for disaster because it can make you second-guess your strategy and motivate short-term portfolio modifications. But looking past near-term chatter to the factors that drive long-term performance is a worthy undertaking. If you find yourself looking short-term, refocus. Number 5. Buying high and selling low. The fundamental principle of investing is to buy low and sell high. So why do so many investors do the opposite? Instead of rational decision-making, many investment decisions are motivated by fear or greed. In many cases, investors buy high in an attempt to maximize short-term returns instead of trying to achieve long-term investment goals. A focus on near-term returns leads to investing in the latest investment craze or fad, or investing in the assets or investment strategies that were effective in the near past. Either way, once an investment has become popular and gained the public's attention, it becomes more difficult to have an edge in determining its value. Number 6. Trading too much and too often. When investing, patience is a virtue. Often it takes time to gain the ultimate benefits of an investment and asset allocation strategy. Continued modification of investment tactics and portfolio composition can not only reduce returns through greater transaction fees, it can also result in taking unanticipated and uncompensated risks. You should always be sure you're on track. Use the impulse to reconfigure your investment portfolio as a prompt to learn more about the assets you hold instead of as a push to trade. Number 7. Paying too much in fees and commissions. Investing in a high-cost fund or paying too much in advisory fees is a common mistake because even a small increase in fees can have a significant effect on wealth over the long term. Before opening an account, be aware of the potential cost of every investment decision. Look for funds that have fees that make sense and make sure you're receiving value for the advisory fees you're paying. Number 8. Focusing too much on taxes. Although making investment decisions on the basis of potential tax consequences is a bit like the tail wagging the dog, it is still a common investor mistake. You should be smart about taxes. Tax loss harvesting can improve your returns significantly. But it is important that the impetus to buy or sell a security is driven by its merits, not its tax consequences. That covers it for today's video. Thank you for watching, and I'll see you all in the next one.